Hey guys, and welcome back to the Finance Now podcast. This podcast is purely for informational and educational purposes, and it's my way of sharing my knowledge, research, and opinions with you. I'm Anurag Birla, and kicking things off this week once again with a macro debrief. So this week we saw the CB consumer confidence coming in at 93 versus a consensus estimate of 99.4. So lower than expected, but also worth noting that this was lower than last month's reading of 98.4. So a slight decrease in consumer confidence from last month. We also saw new home sales come in, which actually showed us weaker demand in the housing market. So the numbers came in at 623,000 versus a consensus estimate of 694,000. I think the question I started asking myself is, could this be a deterioration in consumer affordability in general? Obviously, housing is considered a luxury item. People usually buy it when they feel confident on mortgage rates, on interest rates, and in terms of their affordability and sentiment. And could this be a deterioration? I mean, this is often considered a leading indicator for economic activity. So if that's anything to go by, we are starting to see a slight weakening in new home sales. The other bits of macro data that came out were very important for the quarter. So GDP was revised. Actually, the revised number for the first quarter was actually revised down to negative 0.5%. versus the consensus of negative 0.2%. So this downward revision that we see was predominantly due to weaker consumer spending. And obviously this is not like a good indication for the health of the economy as well, right? PCE, core PCE, which is the Fed's preferred inflation gauge and slowly becoming investors' preferred inflation gauge, It came pretty much as expected, in line with expectations, 2.3% year over year, and core PCE was 2.7%, which was slightly above the expectation of 2.6% year over year. I think this is a clear indication that inflationary impacts from tariffs are yet to show up in the numbers, right? Core PCE may be slightly higher than expected, but it's not much of an indication of tariffs. And I think we're yet to see bulk of the trade deals come in, right? But on that note, we did see US and China pen something down. Bessent did mention some optimism over overall trade negotiations being done by Labor Day, which is 1st of September, and that's significantly further away from the initially targeted July 9th. So I would say, tread here with caution, right? There has been some trouble in paradise with regards to negotiations with Canada, as we've seen, because of the digital services tax imposed by Canada. And, according to Trump, trade talks are supposedly terminated now. I do suspect this may change. There may be some negotiation room here, but since it's early days, I don't really want to speculate. It's just important to know that not all these negotiations are going in the way that people would have hoped, or investors would have hoped, or maybe even the US would have hoped. And maybe just a US-China trade deal is not enough for people to start getting excited about rate cuts, high growth, and a lack of inflationary pressures. Now, moving away from macro, moving on to earnings, there were just two companies, I think, this week that were of interest to me. The first one being Micron, which is one that I've spoken about before on the podcast. And looking at results, this came in better than expected from the previous quarter, which was their fiscal Q3. And not just the results from the previous quarter. It's not just the results from the previous quarter that were good. It was also better than expected guidance. So a classic beat and raise kind of situation. The stock was up a little after, but subsequently fell back down to being more or less flat from the announcement. So earnings per share came in at $1.91 adjusted versus an expected $1.60. Revenue came in, exceeding expectations as well, 9.3 billion versus an 8.87 billion expectation, which was up 37% year over year from last year's reading. This was primarily these solid results were primarily due to soaring demand in the HBM space, right? High bandwidth memory, which is where Micron really operate in. And this is due to the AI boom and the capex expenditure that we've seen all these companies undertake. And this falls under their DRAM products, dynamic random access memory. So data center revenue for them more than doubled in fiscal Q3, and Micron raised its DRAM bit demand outlook for the calendar year of 2025 to high teens, which was previously actually in the mid-teens. And the reason for this is because it was driven by, strong AI data center demand and the improving industrial or broad distribution markets, and not necessarily related by tariff-related pull-ins. Gross margins. Looking at gross margins for the company, the guidance for fiscal Q4 is 42%, which is actually up from 39% in Q3. And this is primarily due to a more favorable mix, which is more DRAM products versus NAND products, and more data center versus consumer products, right? With further gross margin expansion expected into fiscal Q1, right? The more industrial DRAM and data center products tend to be higher gross margin products. So I think with a more favorable product mix and revenue mix, I think that would naturally drive the margins up. The company also expects to generate a pretty healthy free cash flow in the fourth quarter of $15.7 billion in liquidity, and net debt reduced to $3 billion. So this provides flexibility, for them to maybe make investments or dividends, or maybe even share repurchases, depending on how they view the direction of the business. Now, Micron is one of those companies that's done incredibly well. It's up 43% year to date, and it continues to impress. I think even after those results, it really continues to impress. It's no secret that Micron and memory has been a huge beneficiary from the whole AI boom, right? Especially with, as I said, high bandwidth memory and data center DRAM segments. So it's no surprise that Micron has done really well year to date. But despite this significant year to date rally, I think relative to peers, Micron remains pretty attractively valued in the chip space, right? They trade at a relatively low forward PE ratio in comparison. They have strong fundamentals, they have robust cash flow, and they definitely have long growth runway, which makes me believe that momentum for this stock can still carry forward. And there is considerable upside as AI adoption only continues. Now, the average price target, if you look for Micron by analysts, is $146.65. It's currently trading at $124.76. So that's still an implied 17.5% upside from current levels. Micron is a company I like. It's a company I own. There's been good leadership, and they've been a strong player amidst the entire AI boom. And it's definitely one I'm going to keep in my portfolio for the short to medium term, and obviously monitor as updates come out. Now, another company that reported this past week was one that has been a subject of a potential turnaround story, right? And that is Nike. All in all, the company reported better than expected fiscal fourth quarter results. Revenue was also great. Earnings was great. After the call, shares were up about 10%, ending the week with a 5-day gain of 20.77%, right? But obviously this is in comparison to what was expected, but let's break down the results for the quarter. So earnings per share came in at 14 cents per share versus 13 cents, which was what was expected. Net income was $211 million. Now compare that to last year or a year earlier. Last year's figure was $1.5 billion. So this is a massive drop in revenue. In net income, sorry. Revenue was $11.1 billion versus an expected $10.72 billion, and this is still a drop of about 12% from a year ago, which a year ago it was $12.61 billion. So the numbers in context of last year don't look very impressive, but obviously a lot of pessimism was priced into Nike. People didn't think the company was dealing with competition and their loss of China business very well. Their new CEO Elliott Hill obviously came in last year, so there have been a lot of changes at the helm for Nike. If we look at their results a little deeper, Nike Direct, which is their direct-to-consumer strategy, that was down 14%, with digital being down 26% and stores being up 2%. Wholesale was down 9%. Gross margin was down 440 basis points to 40.3% due to higher discounts and supply chain costs. So, again, as I mentioned, it's important to note, going into these earnings, expectations were extremely low by the street, and maybe this is an indication that the worst is behind. That's definitely what I guess analysts in the street seem to believe based on price action of Nike stock. But I guess to start, let's first look at what went wrong with this company. Nike used to be the darling child of athletes. Their brand was synonymous with winning and performance and being elite. You do wonder how and where things went wrong, but seemingly in my head it's twofold. One, the increased competition. The likes of e-commerce has made it just much easier for brands to compete globally. On top of that, you take companies like Lululemon, Alo, that have taken market share in the females department, and then you take companies like On, Hoka, and these other functionally and performance targeted brands that have taken market share in the footwear space, and you see that Nike has actually just trailed some of these names, right? And that leads me to the second point, which is their loss of focus. Nike's core value proposition was for it to be a winning brand in sports. Their loss of focus on sports and their movement and shift into lifestyle has just not worked. They've tried to become that fashion and sneaker brand, and somewhat they've just lost their own identity in trying to do so, which other companies have capitalized on. This is why I think Nike has struggled in terms of sales. Of course, the business is trying to implement a turnaround strategy, what they call win now. And even their new CEO, Elliott Hill, mentioned that this quarter's results are nowhere near where they want to be, which is true. For the current quarter, the ongoing quarter, Nike expects sales to decline by mid-single-digit percentage, which is in line with expectations of down 7%. But a big question for Nike that people had, I guess, with regards to the business and the supply chain is, what would be the impact of China tariffs on the company, right? And of course, these new U.S. tariffs on Chinese imports, they do represent a cost headwind, right? But Nike plans to mitigate this through sourcing shifts, different supplier partner negotiations, and selective price increases starting in fall 2025, as well as potential cost reductions. So they expect a 75 basis points gross margin impact in fiscal year 26, with the largest effect being in the near term of Q1. China as a market, not as a supplier, remains a bit of a struggle for the company, and Hill talked about how recovery in China as a market would take longer than expected. I guess part of their comeback strategy or turnaround strategy has basically been that Hill is going to be unwinding the strategy that their ex-CEO John Donahoe was implementing, right? They're going to move back into wholesale by winning back wholesale partners, and they're going to move back into being sports focused. I have mixed feelings. I'm extremely happy and glad that Nike are going back to being sports focused. That's what they were known for. That's what gave them identity in the first place, right? And doing this gives that brand some identity back. But they stray away from becoming one of the many athleisure brands, right? They stay focused on being elite. However, while I understand the necessity for wholesale, I'm not entirely a huge fan of targeting a wholesale return. I don't mind wholesale, and I think it's important to not completely discredit or be I guess ignorant to the benefits of selling wholesale. But if it comes at the cost of Nike Direct, I'm not a fan, simply because Nike Direct is a higher margin business. I'm not sure how many serious athletes that know what they want actually go into retail stores to find or explore kind of different brands. Usually these people who are serious about sports or serious about performance, they usually are the ones who study the products beforehand, read the reviews, understand what they want, and when they go to the store, they know what they want to buy. I think for Nike, the turnaround will start to come when they actually go back to product differentiation and building a better product. I think that demand will come back simply when they start creating good products again. They've lost out to competition because, their products have become inferior. There's been no edge in their innovation, right? And unless that changes, it doesn't matter what the strategy is. The business isn't going to bounce back. Now, for what Nike is, the market seems to be pricing in a pretty successful turnaround. The forward PE of 36.5 is not cheap. It's significantly higher than a company like Lululemon's forward PE of 15.6. Sure, one can argue that the breadth of the businesses between Nike and Lululemon are very different. However, I do think both companies suffer from similar supply chain and China demand issues. Right? The main difference actually being in recent times is that a company like Lululemon has proven to have a more desirable and sticky product, which is why I think Nike should go back to focusing on their actual product. That said, I like Nike as a legacy company. I'm not saying I don't think this turnaround will happen. I just don't think it'll happen as quickly as markets think it will. And that said, I used to love their products, whether it was tennis items, football cleats, or shoes, and I'm excited for them to go back to being a much more sports and performance-focused company. Now, moving away from earnings for the last segment, I wanted to talk about something that occurred last weekend, and obviously was on the radar for many investors: the Tesla Robotaxi rollout. Right, 22nd June, Tesla launched the long-promised and much-awaited robotaxi service in Austin, Texas. Now, this was an incredibly anticipated event on which a lot of future growth is priced into the stock, right? So it's worth just reflecting on the event and thinking about value versus valuation. The actual rollout by Tesla for the robotaxi was small and extremely controlled. It was just between 10 and 20 modified Model Y vehicles operating within a tightly geofenced area of South Austin. Rides were, only available to a select few invited social media influencers, Tesla shareholders, and early testers. And with the robotaxi rollout, there was a Tesla safety monitor sat in the front passenger seat just in case of a need for intervention. Now, this in itself shows the gradual process that they're taking to roll this out and the lack of full-fledged confidence in the technology as of yet. So, as mentioned, the service was strictly limited. It avoided adverse weather, any complex intersections, and operated only between 6 a.m. and midnight when I guess traffic was low. Riders had to be over 18, and the service area was intentionally small to maximize safety and control. I think between 6 a.m. and midnight as well, it was to avoid the sun, right? Because I'll get into it later, actually, how Tesla, how their technology for full self-driving is a little different to a company like Waymo. But I think when you think about the limitations, it's not that bad of a thing, right? You'd obviously rather want a small and correct rollout versus a large and dangerous rollout, because an accident can be a death warrant to any FSD attempt by Tesla at this point. But, it's clear that the technology is not ready for large-scale adoption. Now, the pricing for this service will be a flat fee of $4.20, and it will be available on the Tesla app. Looking or reading user feedback, it was positive for the most part, from what I researched, and the app integration feedback seemed good too. To me, this is just a bit of noise. It's way too small scale and early to really gauge, and to expect this to make any meaningful difference to Tesla's financials is, in my opinion, lunacy, right? Now, going back to what I mentioned, Tesla used a different approach to full self-driving when you compare it to competitors like Waymo, right? Waymo uses LiDAR, radar, and is multimodal, in detection, but Tesla uses cameras only. And of course, this has clear limitations, right? Blinding by the sun, any natural obstruction. But I think the one benefit is, in terms of scalability, it has the potential to be significantly cheaper in the long run. Now, this process of rolling out and scaling for Tesla is going to be slow. I just think it's a question of how slow. And in my opinion, I think it's going to be much slower than expected. The nationwide expansion is a distant dream at the moment. And I would even argue that a statewide expansion is a long way away from a geofenced small area. Growth and adoption also depends on regulators and reliability on the camera-only system. I've seen online ARK Invest, which is Cathie Wood's fund, talk about how this can be a significant revenue generator for the company by 2029. I just don't see it happening. When you look at competition as well, Waymo is way ahead here. They're already operating on a much larger scale in multiple states, and now you see them pushing into New York too. So basically all this, all I'm trying to say here is that the launch, while symbolic, extremely symbolic in Tesla's innovation, isn't actually going to be material in their performance as a company. Let's be honest, it's not like self-driving technology was that groundbreaking at the moment either, right? If you've seen a Waymo car, or for those of you that have sat in a Waymo car, it exists and it's effective. But the way the stock reacted was somewhat of a surprise to me. I mean, an immediate reaction was positive, but then I think over the week, as I expected, that positivity calmed down, and Tesla as a stock ended the week down 1.15%. I truly believe that Tesla stock, it's a groundbreaking company, don't get me wrong. But its stock is valued based on speculation and expectation, not based on reality or facts. Speculation and expectation is that this is going to be some sort of a super company that's all encompassing, with data, AI, autonomous driving, humanoid robotics, energy, storage. And all these are very, very high growth industries. However, at some point, reality needs to kick in. The brand is losing value. European sales are down, and they're continuing to decline. Regulators aren't necessarily favoring solar at the moment in the US, and high growth industries like humanoid robots are still a distant reality at the moment in terms of adoption. So, I truly believe that the market cannot operate on euphoria or optimism forever. And reality has to hit. And this, Ford PE of 150 plus, north of 150, it has to come back down to earth at some point. And that kind of leads nicely into my final thoughts that I wanted to just share on current market levels and the economy. There are still general economic concerns. I mean, the S&P is at all-time highs, but uncertainty is not necessarily reduced. Bear in mind, we are yet to see trade deals flow in. That deal cycle has been extended to Labor Day. We are at a point in time where globally there is heightened geopolitical tensions, regardless of ceasefires. The tariff implications are still uncertain on consumers, on prices. The Fed is divided on rate cuts. Unemployment is slowly rising. Consumer confidence and sentiment is gradually declining. Yet we find that the stock market is at all-time highs. This to me seems a little worrying. And for this reason, I think the second half of the year remains a little uncertain for me. I would be very wary stepping into the second half of this year. And I think in many respects, reality is going to kick in. And perhaps we would see some sort of drawdown or correction. From a personal opinion, I think it would be good to have some dry powder just ready to deploy if prices fall to a level that you're comfortable with, especially for companies that you may find attractive. But those are just my thoughts on the current state of the market and the economy. Of course, none of what I say is to be taken as formal investment advice. This is all purely opinion and is simply here for educational and informational purposes. But with that, I'm Anurag Birla. Thank you for listening. This is the Finance Now podcast.